Welcome back to Investing Talk Podcast.
Today we're looking at Mohawk Industries.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave in the comments below.
So let's get right into the analysis. Mohawk Industries is operating in what can only be described as a historically tough environment for housing and remodeling.
That's putting it mildly.
Right. But what our analysis is showing is a really high-quality cyclical business, one that has managed to stabilize its operations and is now positioned for a major earnings rebound.
Okay, so let's unpack that stabilization.
Yeah.
If we look at their most recent numbers, Q3 2025, the net sales figure was, what, $2.76 billion?
Exactly. And that's a modest 1.4% increase year over year.
So why is a number that small, 1.4%? Why is that so important right now in this industry?
Because that signals that the bottoming process is likely over. I mean, for the past few quarters, Mohawk and really the whole flooring industry has been struggling, destocking, weak residential demand. So seeing any year-over-year growth at all, even a little, is really the first clear sign that demand is stabilizing, especially on the commercial and international side.
And on the earnings side, the adjusted earnings per share came in at $2.67. I know that just missed the consensus, but what does that tell you about their execution?
It actually tells me the execution is very strong. I mean, missing consensus by a penny in this macro environment, that's not a failure. It's really a testament to their cost control and margin discipline.
They're running a tight ship.
A very tight ship. In fact, if you look at the forward outlook, the consensus is expecting adjusted EPS in the $9.80 range for the full fiscal year 2025.
Yeah.
That suggests the underlying earnings power is very much intact and, expected to accelerate.
Okay, and this is where it gets interesting. We're moving from just stabilization to a really structural shift in the story. Because when you break down the segments, it's not the U.S. pulling the weight anymore.
Not at all. The growth engine has completely shifted.
Hasn't it?
It absolutely has. And this is the key insight that separates Mohawk from, the purely domestic players. Flooring North America was down slightly, 1.2%.
Okay.
But their international divisions were the heavy lifters. Global ceramic sales went up 0.5%, and flooring rest of world grew by 1%.
So tell me more about that international exposure. Why is that ceramic segment specifically providing so much support?
Well, the ceramic segment is just a higher margin business, especially at the premium end. We're not talking about basic bathroom tile here.
Right, this isn't your standard home improvement store stuff.
No, this is high-end European porcelains, specialty products, stuff used heavily in commercial, industrial, and high-end renovations outside of the U.S. And those markets, they often follow completely different cycles than the, let's say, fickle U.S. housing market.
So it's not just about geography. It's a premiumization play. Better margins and less risk when U.S. interest rates are a headwind.
That's it, exactly. It lets them benefit from these trends where customers are choosing higher quality, more durable, hard surfaces. And that boosts their average selling prices even when volume is slow.
Which explains their confidence.
It does. It
Yeah.
explains why management feels comfortable guiding Q4 adjusted EPS to between $1 and $2. They expect that margin discipline to keep delivering, with or without a rapid U.S. recovery.
Okay, so the income statement is stabilizing, strong operations, international diversification, I get it. But let's talk about the foundation. How strong is their balance sheet, given how tough the housing market has been?
It's exceptionally strong, especially for a company that relies on, capital-intensive manufacturing. Their debt leverage is sitting at only 1.1 times.
1.1, that's really low.
It's very low. For a company of this scale in a cyclical industry, it basically means they have minimal financial stress.
Minimal stress is right. I see they have about $1.6 billion in available liquidity. That's a lot of flexibility. So what are they actually doing with all that cash?
They are definitely putting it to work. That balance sheet is a direct result of their incredible free cash flow generation. They did $680 million in FCF in 2024, and that just kept going into 2025, with $310 million in Q3 alone.
Wow.
And that kind of cash conversion lets them allocate capital pretty strategically.
Which brings us to the buybacks. They authorized a $500 million stock buyback program. What does that actually mean for the average shareholder?
It's hugely significant, and this is a really important point. That $500 million represents about 7.3% of the total float at current prices.
So they're taking a big chunk of shares off the
A
market.
very big chunk. When a company retires almost a tenth of its shares, it provides a massive structural tailwind for future earnings per share. Your slice of the pie gets bigger.
They've already started.
Oh, yeah. They've already executed $108 million in buybacks this year, which tells you management thinks the stock is substantially undervalued right now.
So this ability to generate cash to stay strong when competitors are struggling,
Yeah.
that has to come from a core structural advantage, a competitive moat. What is it for Mohawk?
It's really two things: scale-driven cost leadership and deep vertical integration. They're one of the biggest players on the globe, which lets them get better prices on raw materials, run huge supply chains, and build the most efficient factories.
When you say vertical integration, what does that mean in practical terms for flooring?
It means they own the whole process, especially in key areas like ceramic tile and luxury vinyl tile, or LVT. They control manufacturing from start to finish. If you're a smaller competitor just buying materials on the open market, you're exposed to all that cost volatility.
And Mohawk avoids that.
They minimize that
Right.
exposure, yeah, which just reinforces their cost advantage.
Okay, beyond just scale, you mentioned something fascinating before we started, a structural advantage related to U.S. trade policy, the tariff protection.
This is a phenomenal insight. Mohawk does about 85% of its U.S. sales from production right here in North America.
So they're insulated.
They're geographically insulated. And at the same time, the U.S. has kept this significant 145% tariff on Chinese LVT imports.
145%. So what does that do to their competition?
It effectively raises their competitors' costs by an estimated $50 million a year across the sector. So in essence, U.S. trade policy is acting like a continuous, policy-driven cost subsidy for domestic producers like Mohawk.
It's a layer of protection, locking out cheaper competition in a huge growth segment like LVT.
It's a massive structural benefit. It means they don't have to compete just on being the cheapest. They can focus on quality and, importantly, on margins.
So if the company is this cash machine with great execution, disciplined capital allocation, and this protected moat, why is the market still so pessimistic? Is the valuation justifiable?
I don't think it is, and that's really where the opportunity is. Right now, Mohawk is trading at a price-to-earnings ratio of only 16.47.
And how does that compare?
Well, compare that to a fair value estimate, which analysts put around 22.4 times, or the peer average for durable goods companies, which is closer to 24.6.
That's a huge discount. What explains that disconnect?
It's what we call sentiment lag. Investors are just so focused on the immediate pain points, the softness in North American housing, the high interest rates.
They're waiting for the turn.
They're waiting for the turn before they're willing to pay a premium for the earnings that will come when the cycle recovers. The market is just not pricing in that long-term potential yet.
Let's shift over and look at the chart, because the technicals seem to support this idea. The stock pulled back a lot from its 52-week high of over $143, and now has been consolidating around $110.
Right, and that consolidation is key. It shows that buyers and sellers are sort of finding an equilibrium there. The worst of the selling pressure seems to be over. And if you look at the indicators, the 50-day and the 200-day moving averages are converging, right around that $117 to $118 range.
Okay, and that level is critical, because a move above that could trigger what's known as a golden cross. For listeners who might be less familiar, can you explain what a golden cross is and why it's so important?
Sure, yeah. A golden cross is it's a very bullish technical signal. It happens when the short-term moving average, the 50-day, crosses above the long-term moving average, the 200-day.
So short-term momentum is overcoming the long-term trend.
Exactly. It's widely seen as the beginning of a sustained longer-term uptrend. And that $117 to $118 range is the trigger point for that move. It's a psychological signal that often brings in a new wave of buyers.
And we also have some pretty clearly defined support levels to help manage risk here.
We do. The 105 to 180 range has been acting as a recent floor. So for investors who believe in the housing recovery story, that range offers a pretty attractive risk-reward entry point.
And it looks like the smart money, the institutional investors, they're validating this thesis.
They absolutely are. When we look at the flow data, we're seeing significant institutional accumulation at these levels. What really stands out is Norges Bank, which is one of the world's most disciplined long-term investors. They bought a huge block of shares, over 460,000.
So they're not worried about next quarter. They're positioning for the multi-year cycle of recovery.
That's how I read it. And we also saw new stakes from value firms like Donald Smith and Co. and even quant groups like QuantBot Technologies. When you see traditional value guys aligning with the quants, it really reinforces the idea that this stock is cheap on fundamentals and the technicals are starting to look good.
Of course, all this bullish analysis, we have to balance it against the risks. We can't ignore the bear case.
No, you can't. And the primary risk, without a doubt, is the North American housing market. If residential remodeling stays weak and activity stays slow, it could absolutely delay that full recovery. It's the Achilles heel of the story right now.
So how is the company mitigating that very real threat?
Through aggressive, disciplined cost management, they are not waiting around for the recovery. They're forcing internal efficiencies right now. They're expending $110 million in restructuring savings in 2025 alone.
110 million is a massive number. How do those savings help when demand is low?
It comes from things like optimizing logistics, consolidating manufacturing, reducing overhead. And on top of that $110 million, they expect another $32 million in annualized savings. It's all designed to offset headwinds like inflation and tariffs so that when the revenue rebound finally hits, the margins will just expand dramatically.
They're lowering their break-even point.
They're lowering the break-even for the whole company, exactly.
So that makes the stock look a lot more resilient.
Mm-hmm.
Let's pivot to catalysts. What are the next big events that could get this stock moving?
Well, the first big one will be the Q4 2025 earnings report. That's expected in early February 2026. The consensus targets are right around that $1.95 to $2 mark. A solid beat there, or maybe more importantly, strong guidance for 2026, could be the spark the stock needs to reclaim that critical $117 resistance.
But the truly huge catalyst, the one that lifts all boats in this sector, is the macro environment. It's the Fed.
Absolutely. The biggest tailwind would be a potential Fed rate cut cycle in 2026. Lower rates mean lower mortgage rates, which unfreezes home sales and supports new construction. For a company like Mohawk, that would mean a huge jump in volume and the multiple expansion the stock deserves.
Before we wrap up, there are two, let's call them speculative opportunities that are kind of swirling around this name right now.
Yeah, the first one is the growing chatter that Mohawk could be a consolidation target. An M&A target.
Why them?
Well, because of their scale, their strong asset base, global reach, and that pristine balance sheet. It makes them a logical candidate for a bigger industrial competitor or even a big private equity firm that wants to own a dominant player in the building product space.
And the second opportunity is more internal, right? Gets back to margins.
It does. We're seeing management aggressively expand their high-end laminate and premium LVT collections. This focus on the high-margin stuff is expected to drive up average selling prices and boost company-wide margins in 2026.
So what does this all mean for you, the listener? To sum it all up, Mohawk Industries seems to be a high-quality flooring leader, but it's trading at a really compelling valuation discount. It's priced for a recession, but seems to be executing for a recovery.
Yeah. And it has strong cash generation, that tariff-protected moat, and disciplined capital allocation with that huge buyback.
Yeah.
It's a classic cyclical recovery story, but with downside protection built right in.
So this is more of a longer-term play.
I'd view it as a multi-year hold, maybe a 12 to 24-month horizon. The potential for margin expansion plus the tailwind from a future Fed easing cycle.
Really?
It suggests a move toward that $25 target you see from analysts is highly achievable. The question really isn't if the housing market recovers, but how quickly the stock market reprices a company that will benefit so directly when it does.
Don't forget to subscribe to Investing Talk podcast for more in-depth analysis.